So as you guys know, AT&T has been one of my go-to stocks in the dividend portion of my portfolio, especially recently, and that's because they pay a monstrous dividend yield right now of over 7.5% and have actually grown that dividend for close to 4 decades now, thanks to their very high profitability. And yet the stock has been crashing for years, and even to this day, the stock continues to perform very poorly, and that's due to several different reasons, including changing market trends, and of course, the global health crisis that many feel might even destroy their business so much that they may need to cut that dividend in the future. Don't forget, AT&T does have a ton of debt that they really badly need to pay down. Now, you guys know that I obviously talk a lot about AT&T stock on this channel, and that's because it's just a stock I own. I like to keep you guys updated on it, but I usually do so in smaller bites as part of a larger video that usually discusses a number of other stocks as well. So we don't usually have a lot of time to go too deep into detail with AT&T, but today we're going to be dedicating the entire video into doing a deep dive on AT&T and discussing their entire business, how it all breaks down, how they've been performing, what challenges they're currently facing, and how they expect to turn things around in the future so that hopefully that dividend doesn't need to be cut. And I'll go into detail on whether I think it'll be cut or whether I think it's sustainable. And by the way, they just released an earnings report about a week ago, so that should give us some further insight as well. And as always, of course, I'll let you know if I'm still buying this stock myself and what I plan to do heading into the future also. But this should be a fun video. I hope you guys enjoyed. I know a lot of you are either invested in AT&T or sometimes you've thought about investing in it. So I hope you get a lot of value from this video. And if you do, please hit that like button. But we got a lot to discuss. So let's go ahead and start by just taking a quick look at the stock and talk about why it's been falling. And then we'll just kind of go from there. Okay, now this stock has been very volatile in recent years, but it's mostly been a disastrous drop from the top. I believe the highest point that they ever reached was around $44 a share. So today they're down around 40% from those highs. And they're only about $1 higher than where they were at the very lowest point of the stock market crash that we saw this year. So it's really been just a horrible year for them kind of overall. Of course, that's also led to them having one of the most attractive dividends in the market right now, as they yield about 7.6%. That's very high. Now, the payout ratio is a little high as well at 65%, but I'll explain later in the video why it's actually lower than that and why I still feel that it's very manageable, but we'll get to that in just a minute. Their 5-year growth rate is obviously tiny at just 2%, but if you're trying to get a higher growth rate for a dividend that already yields 7.6%, I just think you're being greedy at that point. And then along with the yield though, one of the best things about the dividend is the massive growth history of about 36 years in a row. I know it says 20 there, but trust me, it's actually 36 years. For some reason, Seeking Alpha is notorious for glitching on the growth history. I'm not really sure why. Anyway, why has the stock been falling? Well, to discuss that, we should just do a really quick recap on AT&T's business, and I'll explain where things went wrong. Now, I like to think of AT&T's business as separated into two kind of primary categories, those being business solutions and the other being consumer and entertainment. But to get a little more specific than that, AT&T's products and services mostly consist of telephone, including both legacy landline, which is of course in heavy decline right now as the world moves towards more smartphone use, but that's also led to more growth in their wireless offerings as well, with various smartphone plans and things like that. Then there's video that includes legacy cable TV like DirecTV and AT&T Uverse, which are of course in huge decline given the rise of things like Netflix and the whole cord cutting movement. But then they also have some growth in video streaming and studio thanks to their giant acquisition of Time Warner, which allowed them to package together a Netflix-like service called HBO Max that we'll talk more about in just a second, as well as making them one of the biggest players in the blockbuster movies market, where, for example, their Warner Brothers studio develops all the DC movies, including the new Batman movie with Robert Pattinson and different things like that. Although, of course, the whole pepperoni situation right now is really hurting them. because of movie theaters, but we'll also talk about that in just a second as well. And then finally, there's also internet, which for the most part is always going to do relatively well given all the future growth from rising internet use, artificial intelligence, smartphone use, the Internet of Things, video streaming. All these different things require internet, and AT&T has made huge investments in both high-speed fiber as well as 5G, which are even used by other parts of their business as well. Now, having said all of that, by far the biggest reason why AT&T stock has been falling in recent years is definitely due to the decline of their legacy cable TV business. Back in 2015, AT&T acquired DirecTV for about $50 billion to become the largest US pay TV company, but this turned out to be a huge mistake for them, as the years that followed saw their video entertainment segment drop in sales by literally billions of dollars in both 2017 and 2018, where they declined by over 8% and then another 3% respectively. And this completely correlates with the total revenue declines that AT&T saw in 7 straight quarters during that time, which also further correlates with the crashing of their stock. Now, you might notice these huge spikes around the ends of 2015 and 2018, but those were due to the acquisitions of DirecTV and Time Warner. And it's hard to be optimistic about their video segment going forward, as we're already seeing revenues come crashing down again over the last 5 quarters, especially here in 2020, where the pepperoni lockdowns have also had a very devastating impact on the economy and on people's ability to go out to movie theaters. And that's why the Time Warner acquisition isn't really going well for them at the moment either. Don't forget, Warner Brothers is the second largest film studio in all of North America, leaving AT&T only behind Disney in market share. And all of this has resulted in another 11% expected drop in net income this year, after having already plummeted by 34% and 28% in the 2 prior years as well. Definitely not a good sign. Okay, now I know I just laid out a very grim looking picture for AT&T stock, and hey, that's just the reality of the situation. This is a very risky stock with a declining business, and that is important to be aware of. But at the same time, there are also reasons why I am optimistic about AT&T's future and their ability to turn things around and keep that dividend safe and sustainable. Let me explain. For one, the pepperoni lockdowns and lingering effects will eventually go away. I know that's hard to see now, as we're still in the kind of like in the middle of it, but this thing is not going to be with us forever. And when it does leave, I think we will see a lot of pent-up demand for going out to movie theaters, which should directly benefit their Time Warner business. In fact, we're already seeing some movie theaters open as we speak, and I only think that this will increase over time, especially once a V-Shot is released and people's fears start going away. And personally, I really expect this transition to start happening early next year, so not too much longer to wait, just in my opinion. So that's not a huge concern for me, since I do feel that things will gradually improve, but rather what I feel is the actual biggest problem to focus on is the deterioration of their premium or cable TV business, whatever you want to call it, which has been losing up to 1 million subscribers from DirecTV and Uverse in practically every single quarter since 2017. And as a result, their solution looks like it might be to just kind of cut their losses and get rid of DirecTV so that they can focus more on HBO Max and the other growth parts of their business. Unfortunately, reports say that AT&T isn't getting very high bids for selling off their DirecTV business to any other company, but they're pushing ahead anyway, even if it means taking a major hit on the deal versus what they initially paid for it. On the bright side though, any deal at all will still bring in billions of dollars that they can use to pay down some of their gigantic debt, which they definitely need to work on, since it currently sits at over $150 billion of long-term debt alone. That is massive. In any case, improvements are at least being made, so let's just quickly run through a few of them. First of all, while it's true that they continue to bleed pay TV subscribers, HBO Max has already nearly doubled that subscriber amount after only launching a few months ago. And I get it, obviously HBO Max at $15 a month is not going to bring in the same type of average revenue per customer as something like insanely overpriced cable TV does, which has always been the case. I always hated how overpriced cable TV was. But give it some time, and I think HBO Max could definitely benefit from economies of scale and have a good shot of making up for everything that's being lost. And it's not like AT&T is completely doing away with cable TV anyway. From what I can tell, they just want to sell their satellite business, but will still continue offering their AT&T Now service that streams cable TV to wherever you want it. So having the more focused kind of 1-2 punch of streaming cable for those that want it and HBO Max for those that like a cheaper Netflix-like service could prove to be a much more successful model. And don't forget, it's not like cable TV is all that AT&T has, not by a long shot. In their last quarter, video revenues only made up around 1/5 of their total sales, and I'm not really sure it contributes anything to their profits at this point either. When you look at the entertainment segment, which is basically consumer video and internet, that segment only contributed less than $1 billion of operating income in the quarter, whereas the company as a whole did over $7.6 billion. So that's close to 10 times the amount. And again, this is including things like internet and fiber, which actually grew in the quarter as broadband picked up over 150,000 new subs, with fiber adding another 357,000 subs as well. By contrast, premium TV actually lost another over 500,000 subs. So it's probably safe to say that their internet business might be what's keeping that segment even profitable at all, and it makes sense why AT&T would want to trim some of that fat and sell off part of that business. In reality, the big money maker for AT&T has always been their wireless mobility segment that involves selling smartphones and related wireless plans, among other things, but that segment brings in by far the most profit out of any other segment, while entertainment, which again includes cable TV, is dead last on the list, as you can see on this chart here. And because of that, AT&T manages to still bring in consistently high cash flows every single year, even with premium TV really only kind of dragging them down, at least in my opinion. In fact, last year, their free cash flow still managed to grow to nearly $30 billion, and even over the past 12 months, which obviously include the pepperoni recession, they still managed to bring in around $28 billion as well. In other words, AT&T is still a very large and very profitable company, and this is why I disagree with those that think that the dividend is going to be cut soon. Now, obviously, I could be wrong, but if you look at their third quarter from last year, free cash flow was about $6.2 billion. This year, that's increased to $8.3 billion, and as a result, the dividend payout ratio has actually gone down significantly, dropping from a pretty high 60% last year to a much more very manageable 45% this year. I think for the full year, they're estimating it to be in the high 50s, but even then, I think it was as high as like 70% back in 2016, so I just don't see why this dividend isn't considered manageable. And by the way, here's a screenshot from their most recent earnings report just to verify some of those numbers that I threw at you in case I made any mistakes. Now, obviously, there's a lot of things that can derail AT&T and force them to cut the dividend down the road, not just internally with how poorly they're running certain parts of their business, but also because of external competition. Companies like Verizon, who dominates the wireless market with the most subscribers, and T-Mobile, who by the way just recently acquired Sprint, making them the second largest in terms of subscribers and the number one largest in terms of 5G network in the United States. Both of these companies have much more streamlined businesses that generally experience much higher growth, especially T-Mobile, and they're difficult to compete with. And then in the video streaming market, HBO Max has to compete with gigantic beasts like Netflix, Amazon, and even Disney. And by the way, I should mention that I actually own stock in some of those as well, like Amazon and Disney, for example. But the reason why I still choose to also take the risk on AT&T despite all of these challenges is because they're just so incredibly cheap with such a large dividend that I just feel it makes the risk worth it at this price point. On a forward PE ratio basis, AT&T is by far the cheapest stock on the list at just less than 10. And when you look at dividends, other than Verizon, none of these other companies even pay one. And even in Verizon's case, AT&T is much larger at 7.6% versus Verizon at 4.3%. So just add it all up, and I just think the risk is worth it for me. I know the risk that I'm taking, and I know that their business is definitely in decline. I would prefer to call it in transition, but let's be real here. Their business is in decline, and it could definitely be a long while until we see any kind of meaningful growth from them. And if they continue to struggle, and if things were to unfortunately get worse, then that dividend is at risk of being cut, just because they do have such massive debt on their hands. But I'm much more optimistic than that. I'm hoping that in the worst case scenario, this is just a business that kind of plateaus while they transition, while they cut the fat and become more effective, get a more streamlined business that can pay down their debt over time, that continues to bring in this free cash flow. I don't think their wireless business is going anywhere. That's the cash cow in their business. I don't think the Time Warner is going to really go into decline, because it is so massively large and has so much content and IP. And I think that HBO Max will be successful over the long term as well. So I think the main parts of their business will continue to do well. I think free cash flow will still be there. I think they'll be able to afford to pay that dividend. And that's all I care about. Even if the stock price wasn't to even shoot up or do anything, even if it just stayed flat, even into my retirement over the long term, as long as I continue to collect over 7% on a dividend every single year into my retirement, I'm more than happy to be in this stock. And if they are able to transition their business and be successful over the next 5 to 10 years, I think investors could see the attractiveness of this dividend, and they might start flooding back into the stock. This is a stock that could actually double over the next 5 to 10 years. I don't think it would be that hard for it to even double and make me even more money if they're successful. Now, the flip side, of course, again, if things go bad and they have to cut that dividend, then I think this is a stock that can still drop even dramatically more from here, and I could potentially lose a lot of money, which would be very unfortunate for me. But it's only like my 5th or 6th largest stock in my portfolio, so I wouldn't be like completely devastated if that happened. It would obviously hurt me, but I'm diversified enough to the point where I can take the risk on this stock at this price point. So for me, I just think it's worth the risk. I'm not saying that's the case for any of you guys, but that's just how I feel for my own situation. I'm willing to take the risk at this price point. But anyway, I'd love to hear what you guys have to say down below. Let me know if you're invested in AT&T, or if you've thought about it, or how you feel about them. I know a lot of people really like AT&T, and then I know a lot of people that really hate AT&T, like AT&T stock, and they would never touch it. So I'd love to hear from both sides. Let me know pros and cons. I'd love to hear your thoughts. And if there's any other stocks that you think are better, or that you'd like me to talk about in a future video, make sure you let me know down there as well. But thank you so much for watching the video, guys. If you enjoyed it, please hit that like button. Subscribe if you haven't already. We're so close to 100,000. I don't know if we'll ever make it, but if we ever get to 100,000, that would be very nice. Anyway, I just want to say thank you for all the support, guys. I really appreciate everything. I hope you're all doing well, and I'll catch you in the next one. Take care. Bye-bye.